This is King World News. I'm Eric King, and you are about to hear a very interesting interview with Dr. MARC FABER, editor and publisher of the Gloom, Boom, and Doom Report. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we will have Bob Quartermain, CEO of Silver Standard, and where next week we will have Bob Prechter from Elliott Wave International, Peter Schiff from Euro Pacific Capital, and Jeff Burns, CEO of Pan American Silver. Joining us now is Dr. MARC FABER, editor and publisher of the Gloom, Boom, and Doom Report, website www.gloomboomdoom.com. Mark, one paragraph of your latest report stood out to me. I fully agree with David Pauly, and in fact believe that one of the most negative factors for the longer term is that whereas a serious financial crisis is supposed to clean the system, the current crisis has actually increased dubious financial practices and reduced financial and economic transparency. Therefore, the ultimate financial crisis still lies ahead of us, end quote. Mark, I would like it if you could elaborate on this, because in last week's interview with Bill Fleckenstein, we talked about how the government appears to be encouraging fraud with regards to the bank's balance sheets, and investors, both private and institutional, have grown quite tired of Wall Street's accounting frauds and deceptions, have they not?
Yes, I mean, my whole point is this. I think that we had a crisis already after 2000, when the NASDAQ fell apart, and then the government stepped in, mostly through the Federal Reserve, and lowered interest rates to artificially low levels that discouraged essentially people to save and encouraged them to speculate. And then we had another bubble, the housing bubble. And then the housing bubble came apart after 2006 and led to the current recession, largely because the system was overly leveraged. And now we have essentially the same medicine again applied, this time in more extreme forms, because the deficits as a percent of GDP are much larger, and also because interest rates are really at zero. So it discourages people to save, and it forces me and you essentially to speculate in something with our money at different times. And I think that's not a solution to the problem. I think it's just putting paint on cracks in the building and postponing the problem, but it doesn't solve it. And therefore, I believe that the larger crisis is still yet to come.
Bill Fleckenstein highlighted your letter in one of his most recent MSN columns where he discussed inflation, deflation, and hyperinflation. And Bill wanted me to ask you two questions. First, how long before we start to see a shift psychologically away from deflation to inflation fears? What time frame, in your opinion? And the second question, do you really think hyperinflation is a high probability event?
Well, I think it's important to understand that we had 2002 to 2007, we had a rather inflationary psychology in the sense that all asset classes went up. Interesting was actually that bonds also rallied. And then came 2008, and we had a very deflationary psychology where all asset prices went down and the dollar recovered. And then since March, we had again a more inflationary psychology with commodity prices going up and with stocks going up, bonds doing essentially nothing or going down, and with the dollar weakening again. And I think for the next maybe 3 months, we will have again a more deflationary psychology where bonds can rally, the dollar can rally, and stocks move down. But I suppose that if the S&P would decline to stay around 850, 800, we would then see stimulus package number 2 and more quantitative easing by the Fed. In other words, the lower the market goes and the worse it performs, the more they will inject liquidity into the system. And so at some point, you will get more inflation in the United States. I don't think it will happen in the next 3 to 6 months, but within a year or two, we should see more inflationary pressures emerge.
What about the prospects for hyperinflation? Do you feel that that's a strong possibility? That was his second question.
Well, yes, I think there is the possibility for the simple reason that at the present time, private sector debt growth is being replaced by government debt growth. In other words, we have very large fiscal deficits. Now, the administration says that next year the deficit will come down, but I doubt that this will be the case. I think we were going to see a deficit next year in the magnitude of certainly the size of this year, which is about $2 trillion, and more likely actually a large deficit. And then the problem will arise one day when the Federal Reserve will have to increase interest rates because some inflationary pressures arise, the way they should have increased interest rates more after 2003, but they didn't. So at that time, when the Federal Reserve should increase interest rates, they'll be probably very reluctant to do so, because if they increase interest rates, then the interest payments on the government debt will increase very substantially, and that will then increase the fiscal deficits again. So my view is that whenever it becomes necessary to have higher interest rates, the Federal Reserve will lag the rate of inflation and also the rate of nominal GDP growth, and that this will then lead to a weaker dollar and eventually hyperinflation, I suppose, yes?
Also from your latest letter, quote, "Don't misunderstand me. I am ultra negative about the long-term economic and political outlook. And as I indicated above, I think that this crisis has completely failed to clean the system. But within worsening conditions, markets can still have very meaningful rallies," end quote. You then showed a chart of the Nikkei index between 1989 and 2009. Would you mind elaborating on this point, Mark?
Well, basically, if you look at the history of major kind of stock market bubbles that were driven by monetary policies, usually they occurred in periods of accelerating inflation, and frequently what you had is, in real terms, an economy that went downhill, that went up in nominal terms very strongly. I mean, one of the more recent examples is, say, Zimbabwe. In real terms, the economy is a total disaster, and you have probably in Zimbabwe an output gap of 95 to 99%. In other words, the economy operates way below its potential, but you still had hyperinflation, and in times of hyperinflation, what you don't want to own are government bonds and cash, because that becomes worthless. In fact, in a hyperinflation period, the cash that you have in the morning is in the evening maybe half as much worth. So then people do something with that cash, and they go buy homes and they buy stocks. And so as the economy weakens and as inflation accelerates, stocks will go ballistic. And that is a possibility. And my view in the U.S. is simply this. There are some people who say, well, we're going to make a new low below the March lows. Well, before that happens, the Federal Reserve and the Treasury will again liquefy the system and increase fiscal stimulus packages, which may not be immediately inflationary, but in the long run.
Mark, the Nikkei took 2 decades and an 85% decline to most likely finish its bear market, or close to it anyway. Having said that, would you say eventually, even though we're going to come in and have these stimulus packages, would you say eventually the lows in the United States made in March eventually will be broken, or will they just continue to inflate and prevent that from happening? And I don't just mean in the short term, but the medium to long term.
Well, that is really a good question, and nobody knows. There is very little visibility. I mean, if you ask me how will the world look like in 5 years' time, I don't know. It could be a world where the Dow Jones, because of money printing, is at the 100,000, and it could be a world where, because of deflation, the Dow is at 3,000. The question is really, what are the likelihoods of that happening? I think the likelihood of stocks being higher in nominal terms is significant, because you have Mr. Bernanke at the Fed, and you have a frame of mind in the United States that favors intervention, fiscal stimulus, money printing, and so forth. So in nominal terms, maybe we will not see a new low below 666 on the S&P 500. but we may see it in real terms because inflation adjusted, the Dow Jones is still not very inexpensive.